Auto stocks sitting on the shoulder during today's rally. Ford flat, but GM, Toyota, Honda falling today. The weakness comes after an earthquake in Japan knocked production offline, creating another shock to an already stressed supply chain. Jeff Schuster is following the impact for LMC Automotive. He's president of America's Operations and Global Vehicle Forecasts. Jeff, great to have you with us.
Thanks for having me.
And specifically this component, these are components that are really only made by these manufacturers in Japan, manufacturers like a Renesas, Sony, et cetera. How dire is the situation in your estimation at this point?
Well, it's certainly over the last couple of years, we've obviously had a lot in the industry to deal with. It's the situation is really a stacking of all the problems and concerns and risks. And this is just another layer on top of an already fragile system where we're seeing a lot of pressure on the manufacturing side of the business. And that's really what's holding back auto sales. So certainly something the industry didn't need at this point. It is relatively limited, but it is in the chip arena when you're talking about Renesas, and auto chips are certainly a hot commodity right now.
I mean, Renesas, we saw the impact of taking offline these factories when it had its fire, right? And Ford has already said that 80% of the production loss last year was specifically because of that. How much longer does this go in terms of it being offline to sort of make a serious dent in production forecasts?
It doesn't take long. I think if you look at all the pressure on the industry as it stands already, and then look at just what that plant produced. And as you said, Ford is one of the manufacturers that's potentially at risk here. Just a couple of days can certainly have an impact. It's a short impact or a short-term impact. But I think it's already a tough situation, and chips certainly have been in very short supply already. So this is something that just adds that additional layer of complexity. The supply chain is held up as well as it could, I think, given all the risk and all the issues it's had to deal with. But I start to question how much more can it deal with, if we keep stacking more issues on top of issues.
Hey, Jeff, it's Tim. Thanks for joining us. The other side of that is I look at the global auto sector and I say we're at recessionary levels. And I see so many secular themes and trends that are incredibly exciting, things the auto industry hasn't seen since, since the early days of Detroit. Talk about that, because these dynamics, I think, work themselves out. We talk about this all the time with other sectors where you can delay, but I don't think you will deny the ultimate purchase here.
No question about it, Tim. I think when you look at the auto sector, we look at it in stages, obviously, and the first stage is recovery from COVID, from all the implications around supply chain, and that is going to be pushed out. There's no question about that. We've taken about 3% out of our production forecast since the beginning of the year as these issues start to transpire. But I think the midterm and long run, I think when you look at that transition to electrification, to all the excitement and investment pouring in the EV space, and then eventually in autonomous, it is an extremely exciting and dynamic industry, and I think there's a very strong recovery ahead. It's just a matter of when that really starts to take shape.
In your estimation, what is the biggest pain point right now in the automotive supply chain, whether it be things like microprocessors and the earthquake taking offline that production, or just the difficulty getting some raw materials from a place like Russia, palladium, platinum, rhodium, et cetera, needed for auto manufacturing?
Honestly, that question it's probably going to be different for each of the manufacturers. But I would say if we look at it as an industry as a whole, it's the combination of all of those events that have really created the pain points and the trouble spots of just trying to get some traction in inventory levels and production levels around the world. I think we're also getting to the point, at least in the U.S. and in Europe and in other parts as well, where you could start to look at that balancing of supply and demand, where the consumer starts to feel that impact. Inflationary pressures certainly have put the consumer at bay in some cases, pulled them out of the market temporarily. That they'll come back, but again, it's just a matter of when and how quickly we can get pricing adjusted.
All right, great to have you with us. Thank you so much for joining us, Jeff Schuster of LMC. Interesting, he mentions that the consumer could eventually feel it. We've already seen price increases, at least from the likes of Tesla. BYD Automotive, the maker of batteries that go into EVs, has said that they're raising prices too, Jeff. It's not so far off here. We're seeing it now.
We are, and I sort of dove down an inflation rabbit hole yesterday. We're writing a piece on inflation for our quarterly, and it was striking when you look at cars. I mean, it's used cars and new cars, but right now, cars account for 27% of year-over-year inflation. Over the last 20 years, it's been 8%. So, I mean, you're talking about a major chunk of inflation right now being driven by that industry. If you were to pull out what's going on right now and inflation were to go back to what would be considered normal, 1.5% would come out of year-over-year inflation just like that. So just to put into perspective how important these supply chain issues are that we're talking about and connecting it to the real macro picture of what's the Fed going to do, where inflation's going to go, when you get these headlines, it's not necessarily a good thing, and it's certainly making the problems that we're dealing with right now a lot worse.
Guys, should we be worried that we're going to be hearing about production cuts once again?
Absolutely. I mean, I worry, I wake up worried. So, yes, it's coming. I mean, without question, I think you have to anticipate that. So where's the next trade, the second derivative? You look at AutoNation, which was making an all-time high, I want to say a month or so ago, traded down from 135 to like 102, reported earnings on Feb 14th. Actually, pretty strong earnings if you look at it. And you can make a decent case on valuation. You don't have all that much earnings growth, but I think you have some, again, secular tailwind. So I think you could look at AutoNation here at the 118 level, looking to take out the prior all-time high of 135-ish.
So I own GM. I'm concerned for those companies that have internal combustion engine exposure. That's really where they make all their money. I'm concerned that they finally get supply of SUVs online available right when the consumer, for gas reasons, other reasons, but maybe gas, if you remember in 2008, that happened, and that was pretty bad. So that's kind of a fear why I haven't bought more GM.